The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very good morning to everyone. It's Monday morning. I'm sure you're all bright and breezy, as is Karen Cho and myself, Steve Sedgwick, on Scorebox, and these are your headlines. The dollar index hitting its highest level since November 2022, pushing Chinese authorities to step up efforts to defend the yuan, whilst trade data comes in stronger than expected. Asian equities coming under a bit of pressure across the board following Friday's down day on Wall Street. Well, the December jobs print smashing expectations, but also slashing expectations for more rate cuts this year.
Thus far, to me, the job market looks like stabilized at full employment, not an indication of overheating.
Oil prices rally, Brent topping $81 a barrel to hit its highest level in 4 months, following fresh U.S. sanctions on Russian crude.
The sanctions are imposed today because they will have profound effect on the growth of the Russian economy and make it more difficult for Putin to conduct his wars.
Wildfires continue to rage in California, with strong winds set to return to LA as the death toll rises to 24.
Very good morning to you all. Good morning, Karen Cho. How are you? Well, that's it then, isn't it? We're done. That's the end of the rate cutting cycle.
US exceptionalism reigns supreme.
As I've trying to say to our viewers for a very long time, this jobs market is stunningly robust. 4.1% handle on the unemployment rate. The numbers smashing expectations. Even Goldman Sachs, I notice, over the last 36 hours or so, saying, oh yeah, we're only going to have 2 next year if we're lucky, and that's June and December, and maybe another one sneaking in 2026. Do we now have to prepare the market having to think about it, as it did on Friday, for rate hikes?
Well, the forecasters are having a great old time, aren't they? Even going into non-farm payrolls, what's jumped out to me is how wide the expectations were for the headline print. For
the headline print's nonsense anyway. We've always known that.
But I mean, let's face it, we had a very wide range. And now as we talk about the range of outcomes for the US Federal Reserve, are we still talking about any prospect of a couple of rate cuts was where we started, now towards hiking? I mean, that is a wide range. If we're talking about, are we going to move policy lower, keep it where it is, or actually raise rates? I mean, 3 distinct outcomes from here.
Yeah, well, I mean, look, 2 points. One, I don't know why you get paid out there for trying to call the payrolls. Yes, get paid if you're a Wall Street economist for working out the unemployment rate. That's pretty important. Yes, get paid for working out the average hourly earnings, for the participation rate, but you genuinely get paid for some of your calls on the actual headline payroll, because it's like, oh, there's the tail of the donkey. Nah, I got it wrong again. Anyway, so that's that. The other thing is, what we really need, now we've got full US employment, roughly, anyone who wants a job in America can pretty much find. What we really need is to get rid of a load of people. Just get millions of people, push them back south over the southern border as well. Yeah, that's right, we could deport millions of people because we're already at full employment. No, that doesn't work. Okay, I'll tell you what we'll do then. Because we're full employment and the economy's going quite nicely as well, let's cut tax. Oh no, we don't really need to go. Well, we'll cut taxes anyway, let's do that. I'll tell you what we could do though. If we're really worried about if the Fed can cut interest rates and maybe it's the end of the cycle, why don't we make inflation a little bit hotter by putting tariffs on all the import? Oh, that's not such a good one as well. So the 3 marquee day one policies are on taxes, are on basically deporting a load of people and increasing tariffs. Are they really going to help the situation?
I think what you're alluding to here, does the market really need Trump now on top of what we've just had on the data side? But perversely, isn't that going to be the catalyst for markets from here? Because the data, is that going to improve anytime soon? I think now that we've seen this hot print, it probably puts some question marks over that. So could Trump actually be the next catalyst for markets? If we get a tariff-light regime on trade, then will that be a catalyst for the markets to improve? The reality is we've now put some altitude between some of those peak levels we saw on the US markets versus where we sit today. And we have peeled off some of the high ranges, 5 or 6% thereabouts. So we're now back around the election levels. So we've lost that post-election premium on markets.
And we all know that Mr. Trump sees the stock market as one of his, what is it? You have key targets, KPIs, key performance indicators. When we go to our personnel or HR or our boss once a year and they say, how are you getting on against your targets and everything? And you have your KPI and they say, well, my KPI is how much was I on telly? Well, for Mr. Trump, it's quite important. How did I look? How do you look on telly? That's how he picks his cabinet, you know. How did they look on telly? And one of the other KPIs is how's the stock market going? The machismo of a bull market on the back of my policies. That will cause a little bit of interest in Trump world. Anyway, let's move on. We can talk about this for 4 years if you like. Yeah, okay. Chinese trade data came in hotter than expected in December as businesses started to front-load trade ahead of Trump's inauguration next week. Exports rose more than 10% on the year, whilst imports were up 1%, reversing 2 months of declines. Meanwhile, the PBOC has ramped up its policy measures in defense of a weakening yuan. It relaxed offshore borrowing limits this morning as the currency hovers around a 16-month low versus the greenback. Sam. Good morning, Sam. Lovely to see you this Monday. How are you?
I'm very well, thanks, Steve. Yeah, I mean, some people are calling this a blowout. Not sure. It was a beat, but we got double digits, 10% on the exports. I mean, but as you say, largely expected given the widely telegraphed sort of front loading that we were anticipating ahead of the Trump tariffs. Don't forget, also trying to get those orders in ahead of the Chinese New Year, which is happening in the next couple of weeks. And so that's when those factories do tend to sort of wind down. So there seems to be a lot of appetite to try to get those goods ahead of those duties and before the seasonal effects as well. And so this is what we got as far as the exports are concerned, as I said, so a beat on the headline. Now, the imports are interesting as well because the analyst polled over at Reuters, it's funny you were talking about where's the market at in terms of some of their estimates. Down 1.5% was the expectation here, but we actually saw growth. This was the best reading that we've seen for the inbound shipments since around the middle of last year, since July. Now, this is, of course, very interesting as far as a forward-looking indicator for those future exports because a lot of that material that's brought into the country is then re-exported. Now, this is also down to domestic demand as well, how things are holding up. So that was a surprise to the upside as well, but we're only looking at 1%. So we do need to continue to see this trend moving into 2025. As far as the official commentary goes today, they seemed pretty confident that the trade picture will be resilient in the face of some of these challenges that we're seeing, some of the economic uncertainties, particularly with these Western trading partners. They slammed protectionism, the folks over at the Customs Bureau today. They also said that this whole concern over overcapacity is just hype up. So that's the official line on the trading picture. But as I said, you know, the exports really, this caps off what has been an uneven, very lopsided recovery where the outbound shipments have really been the last leg that China has been left standing on. And so the worry now is if we do see a pullback in global trade and that leg is kicked out from under it, it doesn't have the domestic demand, if you look at those deflation numbers we got last week, to use as a policy offset yet. And so this is perhaps what we're seeing in the markets today, that investors are looking past the front-loading narrative for now and more concerned about sort of the economic uncertainties on the horizon. Back to you.
Sam, thank you very much for taking us through the data today. I want to just peel away from that and take a look at the Asian markets in session. Hong Kong stocks are down more than 1%, so it is a weak old start across the region today. Shanghai market is sliding 0.4, steeper falls too on the South Korean market. The Kospi down well over 1%, and the Nifty 50 to in the red, down 9/10. Japan not trading today, coming of age day, so we don't have Japanese stocks to show you. Now, the US market, it was all about the non-farm payrolls report, the immediate reaction to what it was a blowout on the headline figure, and the market taking stock of the reality that perhaps we're not going to get a rate cut now from the Fed, let alone a couple of them. So recalibrating is what we saw in, again, a further reaction on bond markets that we're witnessing over the course of last week, the heat in the yield, and that really did have a long shadow across on these boards, particularly on technology names. So if you look at the Nasdaq, down 1.6% in session in lockstep with the down reversal, but over the course of the trading week, we did see some significant losses all round. So about 1.8 off the Dow, now close to 7% off its all-time high when it came to the likes of the Nasdaq, trading down for the week as well, down about 2.3+ % for the week, second negative week in a row, and now more than 5% off its peak. So we did see a reversal. And by sectors, it was actually real estate. As we go right to the epicenter of some of those interest rate fears, it was real estate that was punished the most at a sector level in session Friday, but across the course of the trading week. To the dollar. The dollar, no doubt in this context with high yields, has been perched higher, grinding north roughly just under 1% against some of the major pairs and crosses. But euro dollar this morning, we are trapped weak, as you can see, down another 0.2%, 102.23. Cable, 121.5 roughly. That's where we're getting seeing some punishing reactions morning session. We lost more than 1% in a trading session the other week, another 0.5% as we get going this morning. Dollar yen, a lot of conversation about policy divergence too from the Fed to the Bank of Japan now this year. We're 157.50 on that trade, and dollar is also here climbing versus the Swissy. Let's take you to Treasury markets and what we're witnessing here. The 2-year, we're 4.38%. But in terms of the movement, it was the long end that we're watching closely too, and in a roundabout fashion, 4.59% where we started out the Friday close a week prior, 4.76 where we ended up, and you can see that's where we kick off the trading week. So elevation movement at the long end of the curve, one of the safest harbours of this market. The 30-year also budging as well. We stepped up from 4.81% just over a week ago, and you can see we're just 5 basis points shy of 5%, Steve.
Thanks, Karen. Let's go through these numbers one more time. Well, one more time this hour anyway. US non-farm payrolls grew by 256,000 in December. That is significantly beating analysts' expectations and marking the highest level since March. The unemployment rate declined to 4.1%. Healthcare, leisure, hospitality saw the biggest job gains, whilst retail also saw a sizable increase. Well, the hotter than expected payrolls data is making investors worry, certainly if you're in the real estate sector, which was down dramatically, worry that the Fed will target fewer interest rate cuts this year. What about the hikes, though, everybody? Got to start talking about it, because others are. Speaking to our US colleagues, the Chicago Fed President, Austin Goolsbee, said he was confident that the job market was stabilizing and that the central bank will stick to its rate path.
If conditions are stable and we don't have an uptick in the inflation rate and we keep having them come in around 2% with stable and full employment, I think that the rates should go down to where to what I consider to be neutral. And so 12 to 18 months from now, they will be a fair bit lower than they are today. The thing that will justify the speed at which we do that are going to be what happens to conditions.
How do you cut rates when the employment figure in the US is getting hotter? How do you cut rates when you're potentially going to deport millions of illegal migrants in the States? Max Kettner probably knows the answer. He's Chief Multi-Asset Strategist at HSBC. Talk to me about this, Max. What am I missing?
Yeah, good morning. Look, I think we still can get actually 3 rate cuts. I think what we're doing right now is sort of the absolute opposite of what we had in July, August, and September. Remember, in August, people were calling for emergency rate cuts. I remember, first week of August, when we all thought it's going to be quiet and we're all going to be on holiday and, nothing's going to happen. And as always, the summer turned out to be differently. People were really, really calling for, the Fed is unwarranted. It's really threatening the soft landing, and we're getting, to really, really close to a sudden recession. Whereas now, really, we're in the entire opposite. Look at what we had in August, September. We had short-dated inflation expectations almost at 1.5%, and we're pushing towards 3% now. So, you guys were talking about rate hikes. Well, obviously, back then, we had the terminal rate of the Fed priced around 2.7. We're now above 4%. And when we look into 2026, actually, SOFR futures, so interest rate futures, are starting to price almost 10 basis points of interest rate hikes already. So I would say, in terms of how we can make sense of that, and how can you cut rates into that, and isn't that all, does that really make sense at all? Well, the point is, I think, that the pendulum in terms of market pricing has really, really shifted from one extreme, from the dovish extreme, from about 4 months ago, and to the hawkish extreme. I do suspect it could really be this week where we're going to get sort of the last blow up with PPI, with CPI, and perhaps even with retail sales better than expected. And I would say thereafter, we're really, really getting close to buying opportunities in both duration and into risk assets again.
Max, you say the last blowout on CPI. The Chinese are going to throw everything they can at the economy. Eventually, the Europeans are going to ramp up the fiscal as they cut rates at the same time as well. You've got a president who's cutting rates cutting taxes in the United States as soon as he comes in. He's going to put tariffs on a lot of imports, which means that costs are going to go up. Plus, he's going to deport millions, apparently, of illegal immigrants. There's nothing in any of that evidence on a global basis that says to me that the current CPI figure will be the last blowout.
On the other hand, however, number one, we've got that policy uncertainty. So we don't know yet in terms of cutting taxes. Can they really afford to cut taxes? Can we go from 21 down to 15%, or is that more campaign talk? We don't know about immigration. So there's loads and loads of that policy uncertainty around what is actually being implemented. That is number one. Number two is when we look at underlying inflation, particularly in the US, over the not only last 3-4 months, but really the last 12-15 months. In fact, when we look at core, super core, services inflation, the reality is that it's never really gone away. So the market has always been shifting pretty much for the last 2 years, been shifting from one extreme to the other. We've either been playing growth scare, inflation has completely died away, it's completely gone, and we've got to play recession. Or we've played the hawkish extreme, such as we did in April last year, such as what we're doing right now, where the market is saying, oh my gosh, inflation is never going to go away. We're on the brink of a next inflation wave. The reality is inflation has been stuck. We've had this inflation shock, we had disinflation, and we've been stuck around about 3/4 along the way. And, now really in terms of the market pricing, I'd be much less comfortable with saying, hey, there is going to be time to buy the dip in the next couple of weeks in duration, in risk assets, if we still had that really dovish market pricing from a couple of months ago. But we're really shifting to the hawkish extreme there.
Max, let's dig into the risk asset side and what we should be laser focused on from here, because we very much have come off some of the highs on these markets. If we look at the Russell 2K, 11% off the highs, the Dow about 7% off the highs. What do you like in risk assets, and what will you like a lot more if they come off again?
Yeah, at the moment, really being a bit on the cautious side. I think the easiest to express a near-term bearish view is via the Russell 2000, so via being really bearish on the Russell 2000, because as you said, yes, the indices have come down, but when we look at large caps in the US, of course, we never really know, is there something around the tech side coming? Is there, if there is some kind of good news coming for the Magnificent Seven in between again, so then, the easier trade really is being a bit more bearish on the small cap side of things. I do, however, think that when we look at a couple of signs of stresses, they are already emerging. So when we look, for example, at the S&P 500, look at market breadth, we've got almost only 15% of members above the 50-day moving average. So market breadth is extremely poor, which we typically look as a contrarian indicator. When we look at foreign investor flows into emerging market equities, we've just had the biggest outflows from foreign investors in emerging market equities since COVID. in almost 4.5 years. So really, really strong outflows already. And lastly, when we look at our sentiment and positioning stuff, so discretionary and systematic positioning, we are already starting to get real definitive buying signals. So I would say once we're getting closer to that definitive buying opportunities, which could be really coming in the next couple of weeks, it's really back to things like the US banks, things like tech, US equities in particular, but sticking more to the quality and to the large cap angle here.
So I'm having a bit of deja vu. It sounds a lot like 2024, where we had the US economy still expanding high for longer rates to an extent at different points across the year, with only a small decline in that rate ultimately over the course of last year. In that scenario, there were a handful of stocks that outperformed. Why couldn't it not be the same again? We just get magnificent 7 stocks performing for 2025.
I think the first half is actually going to bring that probably. So I think we're freaking out a bit too much. I mean, funnily enough, normally I'm sort of used to that, the year ahead outlooks from strategists and economists would at least hold for a week in the new year. But this time around, it sort of took 2 days until all the year ahead outlooks were dismantled again. So I guess, at the moment, I think we're really, really overdoing it a bit on the hawkish side. I do suspect that when we go further towards the first half, let's remember that, for example, things like super core inflation, so underlying inflation measures in the US in the first quarter last year were extraordinarily high. Part of that was driven by vehicle insurance, which I know is very, very nitty gritty, but it's unlikely that that is going to be repeated to the same extent, at least, this year again, which means we could actually start to see a bit more dovish surprises. One thing that we've also got to remember is that there tends to be this residual seasonality in Q1 GDP data and Q1 activity data in the US, insofar that the first quarter tends to be a bit weaker. If that repeats again, once again, that is not something that people expect at the moment. And of course, with higher yields having ramped up on the front end and the long end, we could be starting to see economic surprises start to roll over in the next couple of weeks again. Nothing dramatic, but not being as hot as it's been in the last 3-4 months, simply because those higher yields start to feed through a bit into the economy.
Max, we're pretty much out of time, but I want to squeeze in a quick one on the UK and what you're seeing on the sentiment side here, given cable's been selling off. We've got these fears around the fiscal room now for the Chancellor. What do you make of the sentiment and where we sit on the UK?
Yeah, I think on sterling, still a bit more cautious. I think on UK equities, however, UK equities to us, from a factor perspective, it's always sort of a defensive market, but value. It's a market where rates are being raised in order to bring growth down. That's not what we're having now. We're discussing about maybe an end of the cutting cycle and growth actually re-accelerating, not going down. So the UK equity market, whilst sentiment is depressed, certainly depressed there, I don't think it's the market to go for right now. It's actually more in Europe, more than the Eurozone, where depressed expectations also in the Eurozone could be leading to a bit of a revival in Eurozone cyclicals in the next couple of months.
Max, we do appreciate you weighing in with some perspective this morning. Thank you very much for joining us. Max Kettner with us, Chief Multi-Asset Strategist, HSBC. Coming up on the show, 2 of Germany's largest political parties confirm their candidates for February's snap election. We'll have the latest next. Plus, feeling guilty? Pressure mounts on UK Chancellor Rachel Reeves as she returns from China. We'll take you through the latest on the UK economy this hour. And don't miss our conversation with former UK Chancellor Philip Hammond that is coming up at 8:30 GMT. Two of Germany's big political parties, incumbent Chancellor Olaf Scholz's Social Democrats and the far-right Alternative for Germany, held their congresses and officially confirmed their candidates over the weekend ahead of next month's federal elections. But the two parties go into this election campaign with very different momentum. Let's get out to Annetta for more. Annetta, we're talking about two parties at different ends of the political spectrum almost. And now in terms of momentum, it seems as though the AfD, fresh from a sit-down with Elon Musk, the new leader of the AfD, or the leader of the AfD, is now looking as though the momentum is with her.
Yes, exactly. Alice Weidel, the head of the AfD, is riding that wave of the far right or populist party, which are getting more and more support also across Europe. Looking at Austria, but especially to the United States, we of course know about the official endorsement from Elon Musk of her party. Also, the recent talk on X, which was showcased across the world, where they portrayed the party as being very democratic and open, but that is actually contrasting completely with what happened over the weekend in Riesa, where they had their party convention. Here they are portraying themselves quite clearly as a very anti-immigration, anti-everything party. So I guess one has to really look into what that party really wants, and whether the international sort of space is more or less one for marketing them as being not really a populist right-wing party. Having said that, at the same time, we've heard from the SPD over the weekend the official endorsement as Olaf Scholz as their candidate for Chancellery, and he is portraying himself as somewhat as the contrary to what Alice Weidel is. Perhaps we listen in.
We've heard some statements from the USA that give cause for concern. That is why I say with all clarity, the principle of inviolability of borders applies to every country, regardless of whether it lies to the east or west of us. Every state must abide by this principle, regardless of whether it's a small state or a very large and powerful one.
In Germany, you're not going to win an election on the economy. You're not going to win an election on your stance when it comes to the United States. I think for Olaf Scholz, at least, that is what also opinion research institutes are saying. It's a hard rally because currently his party is sitting at a record low showing, roughly 16%. And that is actually a lot less than the AfD is currently attracting in terms of electorate. Alice Weidel made it pretty clear over the weekend where her party stands. So it's anti-renewable energy. So she's pledging that if she was to win the election, she would just kill every single windmill from the very second and reinstate nuclear energy. And of course, should close the borders completely to immigration. Let's listen in.
We have a plan for the future of Germany, which we will tackle in the first 100 days of government. Close the borders completely and reject every illegal and undocumented traveller. And a very clear message to the whole world. Germany's borders are closed. Dear friends, they are closed.
So it's a very unusual election campaign because the fringes, like the AfD, also the BSW, the Sarah Wagenknecht's party, are pledging very extreme things to the electorate, like the stop of renewable energies, the completely shutdown of the borders. But one has to say, if we combine them, they actually attract 25% roughly of the electorate for their extreme positions, especially the AfD, who is going to come in second as it stands now in the national polls. And that's not only in Eastern Germany, that's also in part of the West. But at the same time, the traditional parties, the CDU and the SPD, are not going to work with them together. And that is the official, at least currently the official line. Whether we're going to see Austrian relations or not remains to be seen. But for now, as it stands, the CDU seems to be ahead of everybody else, then the AfD and then the Social Democrats.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.